Your accountant is your best friend. Ben Warren of Hilton Consulting is here to give you some simple and practical ideas to change your work methods to stop you going down that business cul-de-sac.
Good afternoon. As Calypso said, my name is Ben Warren. I'm the founder and managing director of Hilton Consulting. We're a firm of chartered accountants, tax advisors and business advisors. When I was first asked to speak today, of course, I gladly accepted, as I always do. I then learned that the title of today's session was Love Your Accountant. And I started to ponder. I started to get a little bit itchy. I thought to myself, am I the PR man for the accountancy industry? Are they sending me out of there to try and prove to everyone that accountants should be loved? It unnerved me slightly. It unnerved me because normally there's a little bit of a seed of truth in every joke. When you think of the word accountant, or you think of your own accountant, or possibly when my clients think of me, I hope they don't, but you probably think of the word dull, grey, boring. You might then think further and think about tax, compliance, bureaucracy, and then ultimately you might think about fees. And that might lead you into a vicious cycle of despair that means that actually you don't build a relationship with your accountant. You don't use them as a resource. But hopefully today, I'll give you some great reasons why you should love your accountant, and then we'll start talking about some key themes that I speak to my clients about, such as to do with managing cash flow and raising finance where needs be, and what happens when there's a problem in your business. So why your accountant? Well, sometimes there's no one else. Sometimes we run businesses whereby you don't have a large board of directors, you don't have a chief operating officer, you don't have a chief financial officer, there's only you. And therefore there is no one else for you to speak to. Perhaps even key employees aren't senior enough or aren't knowledgeable enough about the business that you want to share with them. The days are gone where businesses have ongoing relationships with their bank manager, even if you know your bank manager's name. And even if you do know their name, they're likely to have changed after every 6 months. There's no ongoing relationship with solicitors. Lawyers are used on a transactional basis when a problem arises. So normally, the only consistent person within your business who knows about your business is your accountant. You should be with an accountant or have dealings with an accountant with industry experience. Therefore, the communication you have with them should be relevant, should be timely, should enhance your business. An accountant deals with lots of different companies. They should be a great source of commercial advice. They should be a great sounding board for what you need to do, any questions you have with your business. They should be a port of call because they will be able to assist. There are some accountants who are good news accountants. They pat their clients on the back and they tell them everything is fantastic, everything is great, when really deep down they know that's not the case. Your accountant should also be in a position where they ask you tough questions. No one is going to know your business better than you. No one is going to know the answer to those questions other than you, but the point is, who is posing those questions to give you a moment to think about the answers? Your accountant should ask you tough questions. And lastly, an accountant is someone that helps add perspective. If you're working every day of the week in your business, you're so close to the coalface, you are unable to see the wood for the trees. Your accountant should help you. The accountant should give you a time to step back, have a pause for thought, and add perspective. Try and help you plot the course through your business. Many of the conversations I have with my clients are compliance-based. Many of them are to do with commercial aspects of the business, budgeting, forecasting, and the like. But one of the key areas that I speak to my clients about is cash flow. This is not an obvious conversation to be having with your accountant. A lot of businesses, a lot of clients, they try and sort this out themselves. But when I speak to my clients, I try and make them understand that cash flow is central to their business and the success of it. So what is the importance of good cash flow? There are 4 principles of cash flow management. Firstly, cash is not a given. Just because you're engaged in business, just because you're sending out sales invoices, doesn't mean that you are necessarily going to end up with cash in your bank. Things have to be done to ensure that is the end point. You have to understand that cash is an integral part of the business cycle. You need to understand that it's not just about taking orders. It's not just about building supply relationships. There needs to be a known fact that cash is intrinsic to the development of a business. The third thing is that you need information and immediate access to it. Even the smallest business needs to understand that you have to have the right records at your fingertips to allow you to make decisions about every aspect of the business, especially about cash flow. Part of the role of the accountant is to make sure that you understand the information that your business is generating and how to interpret that. And you need to be able to interpret it in order to be able to control cash flow. And fourthly, be masterful. Understand the importance of cash flow, manage it, control it, monitor it, but you have to do it very, very consistently and as an ongoing basis. How do you start managing your cash flow? A lot of businesses don't even think about it. So you need to start asking yourself some key questions. How much cash does my business have? How much cash does my business generate? How should I get it? When from experience do I get it? How much cash does my business need in order to operate? When is it needed? And how do my income and expenses affect my capacity to expand my business? Business owners of every size do not necessarily ask themselves questions. Here, these examples are specifically to do with cash flow, but they can be questions about any aspect of the business. As soon as you start to ask yourself questions, you will start to understand how you can manage your cash flow within the business. If you don't ask the questions, it will not prompt the answers. Understand that the cash flowing around your business is part of a cycle. Understand that the money gets tied up in stock. It gets tied up in plant and machinery. It gets tied up in debtors. You're bringing in money. You're using that money to turn into stock, to turn into product. There might be then a delay, a long delay until you get paid. It might be terms of 30 days, 60 days. But there has got to be an understanding that there is a circular movement of cash through your business. And as soon as you understand all the interrelationships, again, something you need to potentially to take advice on, you will understand exactly how critical it is to your business. Sometimes a business can run out of cash. Sometimes a business can struggle to get cash in. And the sort of conversations that I have with businesses and clients the whole time try and solve those very questions. So we look at accelerating cash flows. The first thing is thinking about the credit decision. Who are you giving credit to? Are you actually going to credit check your companies? Are you looking at their accounts? Are you doing a credit check? If you take an order, if you make a sale, are you going to get the money in? Or are you just doing sales for the sake of sales? Now, I know because I do the sales for my company as well, and all you want is new clients, all you want is new customers, but you have to decide that the customers you're taking in, the orders that you're taking, are actually going to lead to cash. Just because they sign the order form, just because you send out the goods, doesn't mean you'll get the money. So think about the credit decision. Invoicing your customers. I still have clients that don't send out their invoices in soft copy by email. They still send out paper. They still don't know if they're getting to the right person at the right time. If you send your invoices out by email, it sounds so straightforward, but you can monitor that it's going to the right person. You can check they've opened it. You can then start to work out if they're going to pay you on time. Make sure your invoice has got your payment details on it. Make sure it's got your bank account on it. All of these straightforward things that still clients and businesses just don't do, they can really help to accelerate your cash position if you do it properly. If you just think about the most straightforward of changes, the sort of changes that you might not be able to make on your own in isolation, but ask the question to your key employees, ask your question to your peers, ask the question of your accountant, how can I change things? Think about your terms and conditions. Do you have terms and conditions? Are they properly drafted? Have they been accepted? Are your clients and customers from experience just ignoring your terms and conditions? In which case, do you need to start again? Make sure that make sure that they understand what they have to do. Make sure that they understand that they have to pay within 60 days, and if they don't, there will be penalties. Make sure your terms and conditions are up to date, properly drafted. A lot of clients, when they're starting out, they just look to a nearest competitor or a nearest supplier and they crib their trade terms and conditions. Make sure the trade terms and conditions are specific to your business and are specific to your business needs. Because just by cribbing a neighbour's doesn't necessarily mean you're going to do the right thing. Ways to accelerate cash flow. Just start thinking, asking the questions and thinking about the answers to the questions as they arise. Understanding what your business needs, understanding what cash is available. You just can't do it on the back of a fag packet. You need to start building a cash flow model. Your accountant will love Excel. I love Excel. You might not love Excel, but start thinking of a way to draw up a basic template. Start thinking about what records you need, because this will go back to the point that you'll make decisions based on relevant information. Think about who is going to be using the cash flow. Is it for you? Is it for your key employees? Is it for a bank to raise finance? Because different users of cash flow models will require different things. They will need to interpret them in different ways. Keep it simple. Make sure you can actually interpret and go back to your cash flow model regularly. People are always optimistic when they build in cash flow models. They always think, oh, I know from historic information, I know my customers can pay me after 45 days, but I think I can encourage them to pay me within 30 days. People are always over-optimistic. Oh, I know my costs have been historically a bit high, but I'm sure I can cut them by 10%. That's going to improve my cash flow. Don't be optimistic, be realistic. Start from a worst-case scenario and then flex your model to make a situation either worse if things deteriorate or better if you can improve terms and the like. But be realistic. Start with what you know. Clients always turn around to me and say, well, how do I know where my sales are coming from? How do I know what I'm going to earn? How can I generate the cash flow in my cash flow forecast if I don't know? Start with the costs. Work out what you know. You know what your wage costs are. You know what your office costs are. You know what your accountancy costs are. Start with those elements of it. Then you know what sort of margin you're trying to achieve within your business. So then scale up the costs so you can see that you have a target, firstly then for cash flow and secondly for sales. And you can then use the cash flow forecast, not just for cash flow forecasting, but also for profitability forecasting as well. Ask your accountant for a basic template. They will happily provide it for you. And that encourages the conversation that you should have with them. They will start then asking you questions. If you do need to find extra cash, if you've made the decision either in a positive and proactive way or in a reactive way that you need to find more money, then you need to develop a business plan. Now, I hope that many of the businesses here already have a business plan, that you already have a template for where you want your business to go, where it is now, and how you're going to develop it. I try and get all my clients, both startups and mature business, to visit their business plan straight away, to draw one up, and then to go back to it on a timely basis to see if they're hitting key benchmarks that they've set for themselves. If you have a business plan, if you have an understanding of where you want your business to go to, at the beginning of the inception of your business, then that's something you can monitor all the way through. If you're raising finance and you don't have a business plan, you'll have to write one for that specific requirement, and all people that are likely to give you money will want to see it. You know your business. You will be able to cover off most of it. It shouldn't be a daunting proposition to write a business plan. You shouldn't have to spend lots of professional fees with help on your business plan. You might need assistance with the numbers. That's what the accountant is for. But you know your business, you understand it, you can build most of it yourselves. Any person who's going to likely to give you fundraising is not going to want to see a kind of a template that's been provided by your accountant or by a business mentor somewhere. They're going to understand the business from your own perspective. But you'll need a business plan. Where can you go with your business plan? The first thing to do is for a proprietor to look at what they're drawing from a business. Can they cut back in what they are taking from their business? Can they reduce their drawings? Because that's the quickest way to try and retain more cash within the business. Possible, maybe. Then you could possibly look to friends and family. Some people don't want to go to friends and family because they don't want to have an awkward conversation. They don't want the moral dilemma of potentially stalling a friend or a family when they can't pay them back if there's continued problems. But then if you can't get it from an immediate source, you have to decide whether you're going to look at debt finance or equity finance. Debt finance, things like bank loans, bank overdrafts and the like. Equity finance is when you give away a proportion of your company. Decide what your needs are. Your business plan and your forecast will help you define the timescale by which you need the money, and you'll understand the quantum. And sometimes that in itself will lead you in a particular direction between debt and equity. Because it might be the quantum of the money you're looking for to move your business on is just too big for a bank. They're just not interested. There are still banks who lend, but it's increasingly difficult. You've got to have a very strong business case. So it might be that the quantum of the loan will rule out traditional bank or debt finance. So you need to look at equity. Well, then you get into the whole moral dilemma of whether you want to give away ownership of your business. These are the sort of conversations that you need to be having internally, the sort of conversation you need to be having with your advisor. The advisor will always also suggest different mechanisms to try and encourage investment. Things like EIS scheme or SCIS scheme. equity raising finance deals which incentivize the investor, which give them tax breaks on the investment and the possible sale of those shares if they invest in the equity. All of these different options will help build a picture of what you can do, what are your options, who should you go to, how much should you ask for. And there are other things you might have read about, peer funding, like the funding circle, or crowdfunding. These are more kind of modern or newer ways of raising finance, depending on the type of business you run and depending on your requirements. Your business plan will determine which source of finance might be most relevant for you. Your forecast will help you determine what the quantum of that money will be, and out of that, your ongoing conversations will decide whether it should be debt, equity, and what sort of finance will be raised. These schemes, these equity schemes, are very, very straightforward to do. Gone are the days where you'd go to your accountant and they'd say, oh, it's going to cost you thousands of pounds to put together an EIS proposition. They are very, very straightforward now. There are compliance fees, but they pale into insignificance in terms of the ability or the ease that they help you raise finance. There are also business angels out there as well who might take an interest in your industry, might not have anything to do with your industry, but just like you as a person or like the business sector you operate in. And there are networks of business angels who are out there, who take in propositions, who consider. Again, your accountant should be able to put you in touch with these networks. Your accountant should have lots of contacts for you to help. What happens when you run out of cash? The first thing is you need to see it coming. Because you've done your cash flow model, you can. You need to start chasing your debts. You can stall suppliers. So one thing I say to clients when they've got some cash flow problems is if you've been regularly paying your trade suppliers on 30 days for 5 years, 10 years, and you have a good relationship with them, if you're struggling in a moment in time, to pick up the phone to your suppliers and say, I can't pay you on 30 days, but I am going to pay you on 45 days or 60 days. If you've got a good relationship with your trade suppliers, there's no reason why they shouldn't agree. Stay in contact with them, but that's a great way of just trying to extend a little bit of finance. Plot the course. Understand where you're trying to get to. Understand what the end of the struggle might be or the end of the crisis might be, or if you're raising finance for growth, where you want to be once you've got that finance in place. But you need to know those staging points. You need to understand them. You can't just bundle your way through. Tell the bank. If you've got bank borrowing, bank overdraft, bank loans, speak to your bank manager. Tell them there's going to be trouble with meeting your interest payments. Tell them you want a holiday. They will be sympathetic. If you don't feel comfortable, ask your accountant to make representations on your behalf. These are the sort of conversations that we have the whole time, and they come more naturally to us. Shift stock. If you're holding stock, just get rid of it. Just sell it. Doesn't matter about margin in that respect. You just need to generate cash in. You need to understand you've got to turn the cash. Take a salary holiday, as I've mentioned. Don't take as much money out of the business. Think about the tax man. Think about when your next VAT payments are, when your next corporation tax payments are. Can deals be done with the VAT man to slow the payments down? Can you pay in instalments? Prepayments. Try and get customers to pay deposits. See if you can move some customers onto pro forma. Do something with regards to the way you invoice to try and get that money in slightly more quickly. And get tough. You have to make hard decisions. You have to cut costs. You might have to cut staff. You might have to put them on short time. It's very, very difficult to make hard decisions when you run out of cash, but these are the sort of things you have to do. Alongside cash flow planning, we give commercial advice, we give tax advice. Sometimes they're intertwined when we have to do deals with the tax man to try and stall payments. But your accountant should be the person that helps you not just with the compliance, but with tax planning and VAT planning. And if you've got an ongoing relationship with your accountant, if you trust your accountant, if you love your accountant, then they will understand your business. They will be able to make suggestions. I have clients, every accountant has clients that just want to see their accountant once a year. They just want to drop off their stuff to do their tax return on the 31st of January, the day of the filing deadline. They don't care. But that doesn't allow your accountant to advise you proactively. All accountants will use the phrase added value. I hate it. But, big but, the only way that they can even stand a chance is by having an ongoing dialogue with you about your business, about your tax compliance, about your tax planning opportunities, seeing you more than once. Don't be scared that you will raise a fee note. They will raise a fee note. Ask questions. Ask your accountant to put you on a fixed fee program potentially, but just have the confidence to get in touch with them so you can speak about VAT planning We integrate the advice. We look at cash flow planning, we look at tax planning, it's all joined up. We look at staff bonuses, we look at pension contributions around year end, we look at capital expenditure, we look at all these basic things that every business should be considering on a year-by-year basis, but you can't necessarily do that in isolation. You can't necessarily do that on your own. You have to rely on your professional advisors. Simple stuff, but only when you're as part of an ongoing dialogue. I like to think that my clients can pick up the phone to me at any time. I say to any client, I don't care how many times you ask the question, I don't care how silly you think the question is or how straightforward you think the question is, just ask. Because I would rather they got the answer and they understood the problem for themselves. Still, as I say, clients don't always pick up the phone. They're always still nervous. But you have to try and enter a dialogue with your accountant, with your advisor. They will be able to help you in the good times and in the difficult times.